Greetings. The purpose of this video is to introduce you to our divergence algorithms and how you can utilize them in some of our sharp vision traders indicators. This algorithm will be applicable to every indicator we provide with divergence as a feature. Having a high-level understanding of the algorithm will aid you in navigating correctly and confidently. Divergence is a powerful concept in technical analysis that can help traders identify potential trend reversals or continuations before they occur. But before we delve into the details, let's start with a brief overview of what divergence is. In trading, divergence occurs when the price of an asset and an oscillator, such as the Relative Strength Index, RSI, or Moving Average Convergence Divergence, MACD, move in opposite directions. This discrepancy between price and oscillator signals a potential change in momentum and can provide valuable insights for traders. As you should be seeing on the screen, there are 4 types of divergences: classical bullish and bearish divergences, and hidden bullish and bearish divergences. The classical bullish divergence occurs when the price of an asset forms lower lows, but the oscillator forms higher lows. It suggests that while the price is declining, the momentum is actually shifting upwards, indicating a potential reversal from a downtrend to an uptrend. Traders often look for confirmation signals, such as bullish candlestick patterns or trendline breaks, to enter long positions. Secondly, the classical bearish divergence, on the flip side, occurs when the price forms higher highs, but the oscillator forms lower highs. This indicates that while the price is rising, the momentum is weakening, signaling a possible reversal from an uptrend to a downtrend. Similar to bullish divergence, traders seek confirmation signals such as bearish candlestick patterns or trendline breaks to enter short positions. The hidden bullish divergence occurs when the price forms higher lows, but the oscillator forms lower lows. This suggests that while the price is retracing, the momentum remains strong, indicating a continuation of the current uptrend. Traders often use hidden bullish divergence to add to existing long positions or to enter new long positions during pullbacks within an uptrend. And finally, the hidden bearish divergence occurs when the price forms lower highs, but the oscillator forms higher highs. This indicates that while the price is consolidating or retracing, the underlying momentum is still bearish, suggesting a continuation of the current downtrend. Traders may use hidden bearish divergence to add to existing short positions or to enter new short positions during bounces within a downtrend. By understanding and identifying these 4 types of divergence, traders can gain valuable insights into potential trend reversals or continuations, allowing them to make more informed trading decisions. Other pointers to keep in mind: make sure to trade divergences in a trending market and not a ranging market. Be aware of support and resistance lines in the broader market spectrum, and also divergence prediction is best when there is a breakout supported by volume and understanding of the overall picture of the market. Now that we've covered the basics of each type of divergence, let's move on to explaining how our divergence algorithms work and how they can be applied to our sharp vision traders indicators. There are 2 methods: the histogram method and the curve method. We will start with the histogram method, as it is simpler to grasp. The histogram method is typically used for any indicators that generate a histogram as their output. It evaluates divergence by examining the intervals that fall above and below 0. For identifying bullish divergence, we look at negative segments where a positive set exists in between. Conversely, for bearish divergence, we assess positive segments where a negative set is placed in between. The algorithm will proceed with evaluation with the close of each bar by navigating backward in time. It's crucial to grasp why this method is employed. Without setting limits on the intervals between sets, a potentially large number of divergences could be identified, leading to a cluttered analysis. This approach is particularly adept at capturing the extremes of market momentum, whether in bullish or bearish trends. Furthermore, this method provides greater adaptability compared to other divergence indicators that require users to specify a look-back period. With the histogram method, and the next method to be introduced, The look-back period is organically determined by the alternating bullish and bearish segments, enhancing its responsiveness to market changes. Our algorithm includes features designed to limit false signals, such as curve smoothing, which helps reduce noise. Additionally, a unique aspect of our divergence indicators is the option to set strict criteria. If a divergence line crosses the price line, the evaluation is discarded, ensuring more reliable signals. However, users should be aware of certain limitations designed to reduce clutter and provide more meaningful evaluations. Firstly, no divergence will be evaluated within the context of a single set. Secondly, once a divergence is detected between sets, no further divergence evaluations are conducted. This approach helps focus on the most significant market signals. The second approach to generating divergence is called the curve method. It involves generating an average signal curve from the original indicator's curve. This, of course, is based on a user-defined look-back period. From this, a differential curve is created, which is subsequently transformed into a histogram. This output histogram is then normalized and, if required, smoothed to help minimize and eliminate noise. The features of the curve method are similar to the histogram method. The only outlier is the ability to only evaluate divergence if extremes such as overbought or oversold are reached. Limitations are also similar to the histogram method. Now, we will move to demonstrating functionality. Please remember that the outlined examples will be applicable to all indicators that come with the divergence detection feature. The first example being shown is the derivative RSI. As you can see, the output is a histogram by default. We will demonstrate options and features of this indicator. Again, as mentioned, this setup will be the same for all histogram-based indicators. When enabling divergence, you will notice that you can set the number of sets to be evaluated. We will only be looking back through one set. The more sets you desire, the higher the number should be. Strict divergence can be enabled if I is desired not to include price line that would cross any of the price candles. The other options related to the desired divergence curves to be displayed and also the associated presentation of the slope lines. Now, we will be demonstrating an indicator that can utilize both the curve and the histogram method. The example shown is of the RSI indicator. Recall that an RSI indicator is also bound by upper and lower limits. All indicators utilizing the curve method will have the option to smooth curve. As you can see, there are a couple of smoothing options here or none. Smoothing is an essential tool in reducing noise and thus eliminating non-applicable divergence readings. After enabling divergence, you'll notice that options are similar to those of histogram-based indicators. This is especially true if the chosen evaluation type is histogram. However, and since this is a bound indicator, the user will also have the option to only evaluate divergence at the extremes. Histogram option is also available for bounded indicators. It will not be available for indicators that are not bounded. Let's also go ahead and change the evaluation type to signal, as described previously. What this will do is produce a signal curve and generate an internal histogram from the differential of the main and signal curves. And as mentioned previously, choosing the curve method will require the user to enter a look-back period for the signal curve. We will pause for a little for now. Please review the demonstration of options available for the user. And finally, we'd like to thank you for taking the time to view this. We strive to provide the best tools out there for traders to help them make informed decisions. Please stop by our website or channels and browse our large selection of indicators, studies, and strategies. As always, you are welcome to reach out to us for any questions, support, or request. Have a nice day and trade responsibly.